we have just looked at two examples of the cost flow method. Now let's do a brief comparison here of FIFO and LIFO. So the financial statement impact, which method would give you a higher cost of goods sold when the purchase price goes up? Is it under FIFO or LIFO? So if the purchase price is going up, which one will be higher? LIFO will be higher. Why? Because here it is cost of goods sold. So if the purchase price goes up, first in, first out. So if the first in, first out, it will give you, we're going to take the lower price. Versus if we're using last in, first out, we're taking the higher price goes out. So LIFO will give you a higher cost of goods sold. And then cost of ending inventory. Under LIFO, it will be lower because the higher price goes out. So what is left at the lower price? And how about gross profit? Under LIFO, because the cost of goods sold is higher, so the gross profit is lower. And how about income tax? Because income tax is associated with your gross profit. So under LIFO, it is lower. However, when purchase price goes down, so when the purchase price goes down, LIFO would give you lower cost of goods sold because this inventory goes out, and what we have left are higher prices. So cost of ending inventory under LIFO will be higher. And then gross profit, because cost of goods sold is lower, so under LIFO, gross profit is higher. And then income tax is higher as well. So the advantages and disadvantages of the two methods. The advantage of FIFO, first in, first out. So first of all, it leaves the current cost. So first in, first out, it leaves the current cost and the cost of ending inventory. What we have left is the current cost. So it produces a better measure of the cost of the ending inventory. It is more relevant, right? Because it is the most recent cost that we have left in the ending inventory. And with decreasing purchase price, FIFO is the lowest income tax. So this we have just mentioned. And the disadvantage of FIFO, because we put the old cost into cost of goods sold, so it's resulting in poor matching of revenue and cost of goods sold. This is because for revenue, that is the price we're selling this product. So that must be the most recent ones. But for the cost, because we're using FIFO first in, first out, so we're taking from the old inventory cost. So it produces a poor matching of revenue and cost. And versus if we're using LIFO, last in, first out, we put the recent cost into cost of goods sold, last in, first out. So what goes out are the most recent cost. So it produces better matching with revenue. That's better measure of net income. But with increasing purchase price, which is because like usually in the society, we have a little bit inflation. The price tends to go up over time. So with increasing purchase price, LIFO yet lowest taxable income. So reduce tax and thus improve cash flows. So this is the advantage of LIFO. And the disadvantage of LIFO, last in, first out, is it leaves the old cost in the cost of the ending inventory, resulting in inventory recognized on the balance sheet bear little relation to the current cost level of inventory. So this is because we're leaving old cost for the cost of the ending inventory. So it's resulting poor measure of our income inventory account on the balance sheet. And manager may manipulate earnings through LIFO liquidation. So this we're going to talk about in a minute. And So it is not permitted action under IFRS. So LIFO is not permitted under IFRS, even though it is permitted under US GAAP.